Okay, welcome. Tax 101. I'm going to try and break down the complex topics of tax residency, how people move offshore, paying no to low taxes in crypto, the mistakes or incorrect assumptions people make, and how to go about this correctly. This is a complex topic and there's a lot of nuance in a lot of areas. And this is by no means everything that there is to know about international taxes or moving offshore. But hopefully this provides a good foundation for you. You'll know more than most by the end of this, and it'll help you determine whether you're ready to move offshore and save taxes and live a new lifestyle. None of this should be considered tax advice. I'm just trying to make tax knowledge more accessible so more people have a broader understanding of tax, as this is really something that should have been taught in schools. Okay, so let's dive in. But before we start, a brief introduction on me. My name is Elliot. I started off over 10 years ago as an accountant in London. Didn't go to university, but I was going down a very traditional path as an accountant. But I looked around the office during my first job and the partners of the firm there, and I didn't want their lives, stressed and, a little too fat to fit into their jags. I came across Tim Ferriss's 4-Hour Work Week and thought, this is someone who I can aspire to be like: successful, wealthy, in good shape, travels, does cool shit. So alongside my traditional accounting career, I started businesses in Amazon FBA and an info product teaching people how to grow their followers on Instagram. And it was only during COVID that I decided I could bring my experience in accounting and tax and my interest in entrepreneurship and business together. So I have a firm in the UK that helps individuals and companies with their accounting and tax needs. And then during my own journey, I've left the UK as a tax resident and helped many of my clients do the same. I facilitated setups all over the world, with a lot of clients opting to set up in Dubai, although that is not the only option out there. I've also worked with entrepreneurs and business owners to help them leave their own countries of tax residence, such as Canada, Australia, all over Europe, create an offshore plan for them and help bring their tax to zero or as close to zero as possible in their situation. And so while many of you are probably just interested in knowing how to avoid paying taxes on your crypto, you'll need to understand a bit about how the broader tax system works to figure out the best low tax crypto strategy for you. Okay, so let's jump in. So there's 3 different types of taxation: citizenship-based taxation, residency, and territorial. Okay, so we'll break down each of those. So citizenship-based taxation. There's actually only 2 countries in the world that have citizenship-based taxation. One is the US and one is a country that you've never heard of. And so no matter where you live, where you move to, these countries will still tax you. And so, there are foreign tax credits, exemptions, and if you live in the US, you can go and move to Puerto Rico to dramatically reduce your taxes. But ultimately, if you want to take advantage of the most low tax strategies in the world, people from the US need to give up their citizenship and get a new passport. Okay. Residency-based taxation. So this is the most common form of taxation in the Western world. The UK, most of Europe, Canada, Australia, all of these countries follow a residency-based taxation model. And it basically taxes you based on where you're a resident of. Now, just because you have a residence permit doesn't automatically mean you're a tax resident. And that there is a difference between residency and tax residency, but a lot of people use them interchangeably and a lot of people don't know the difference. And so tax residency is usually determined by the time you spend in a country and where your permanent home is. Now, a lot of people will just look at the 183-day rule. And what that means, if you haven't heard of it, is that you're a tax resident if you spend 183 days or more in a country during that country's tax year. And if you don't spend 6 months, then you're automatically not a tax resident. But it's often much more nuanced than that. The 183-day rule, and I know I say rule, that's just how it's referred to as sort of colloquially, it's a good rule of thumb for not picking up a tax residency in a new country, but it's a guide, not a rule. Like residency-based taxations, they'll usually look at a number of factors, such as the place of your permanent home, your ties to a country, etc. Like, I don't know, wife and kids, children, bank account, gym membership, etc. And so it is possible to spend 5 months in a country per year, but have tax residency there. Okay, let's look at the third type of taxation, territorial-based taxation. So these countries, they will usually tax local income regardless of the residence of the taxpayer, but foreign source income is exempt from tax. So what does that mean? If you live in Costa Rica and you run a surf shop, even if you're not a tax resident there, they'll tax that locally sourced income. But foreign source income, meaning like rental income from abroad or dividends, passive dividends from abroad, those are exempt from tax. Now, different countries have different rules and the definition of foreign source income changes. But as a general example, you could live in a territorial tax country and then receive foreign dividends and they would be tax-free. Bear in mind, if you're a solo entrepreneur managing the company from that country, but it's set up offshore, you can start to get into a bit of a gray area because whilst you might be receiving dividends from offshore, that income might not actually be considered a foreign source because it's coming from an offshore company because you're managing it from that country. We'll get into some examples of this later so you can see how it comes together, but just understand that there are countries that tax your worldwide income if you're a resident there, and there's countries that tax local income and foreign source income is exempt. So here's 10 well-known countries with territorial-based taxation, and it's by no means an exhaustive list. And if you're interested, you can simply Google territorial tax countries, and Wikipedia has a really thorough list. Okay, now we're going to look at the concept between personal and company tax residency. So while a country might tax you personally based on your passport or where you live, a company has its own tax residency, meaning it's taxed differently to the way you are, and this is generally a benefit. And so this generally defaults to where the company is incorporated. However, it's possible for a company's tax residency to change based on where it's managed from. There's a reason that every company in the world isn't set up in a 0% tax country. Like if your hairdresser set up in an offshore company to run their business, their company would pay tax wherever they operated from and had a premises, making the offshore company effectively pointless. And a lot of people who run online businesses make this mistake. They assume that because they do work online, this rule doesn't apply to them. But if they live in the UK or Australia or Europe or pretty much any other country, and they set up a company in, say, Dubai, they're the only shareholder and director, they run the company, and they make all the clear decisions, but they continue to live full-time in the UK or wherever they're living, they don't get to pay 0% taxes. The Dubai company then needs to pay taxes in the UK, and they still need to pay personal taxes in the UK too. Just because you keep the money in a foreign bank account doesn't avoid this either. And as I say, this doesn't just apply to the UK, this applies to almost every country in the world. So you can't just set up an offshore company and avoid tax. You almost always need to change your personal country of residence in order to maximize the benefits. Okay, there's another key concept called domicile, and this is generally considered as the place of your permanent home. And it's often used by countries with a residency-based taxation to determine tax residence. Now, different definitions, depending on the country, you'll see it often as a key term if you're looking at tax residency rules and starting to create an offshore plan for yourself. Okay, the next sort of concept and theme we need to look at is the rise of online income and how this has changed the dynamics of tax around the world. So tax authorities are reliably slow to update their rules and adapt to the modern age. And so most of the tax law in effect around the world was created before people started earning money online. And the definition of a company, that used to mean multiple directors with lots of employees and various physical locations. Now a company can just be you in your underwear on your laptop and a handful of freelancers. This makes it harder for tax authorities to keep track of individuals and companies, and it gives entrepreneurs huge amounts of flexibility in terms of where they want to live, where to set up their business, and where to pay taxes to. Tax policies were also created per country, not globally, right? So this is a very basic illustration of how some countries' tax policies overlap, how some don't, and therefore how offshore strategies can get created as they basically look to just position individuals in the gaps between the taxation to allow the individual relative freedom when it comes to taxes. The gray area. Okay, so often a good offshore strategy will combine like a number of different countries' tax rules together to then find a legal loophole or a legitimate tax exemption. And there's often an element of judgment in any offshore strategy by the nature of the definitions different tax authorities have regarding permanent home, place of residence, domicile. It's very rarely clear cut, and there's an element of judgment. And so when you then start to layer in different countries together, you're stacking judgments on top of each other. And this is arguably by design by the governments and the authorities, because if you're ever investigated, it's not necessarily black and white, and they can rule to a certain extent as they please. You can argue both ways. And the best example of this is that you ask 5 different accountants about an offshore strategy, you might get 5 slightly different answers. And a lot of that just depends on that accountant's risk tolerance rather than what the actual rules are. So some tax strategies are really clear cut. Others combine these definitions from multiple countries and have elements of judgment in them. Some are altogether just illegal and rely on you not being found out. And another key important point to note is that regardless of your strategy, and even if you're doing everything 100% by the book, no one wants a tax audit. They can suck up huge amounts of time, stress, and resources. Okay, let's step back a bit and look at the point of tax. So the point of tax is to generate revenue for a government to run the country and then provide services and benefits to its citizens and residents. And so if taxing its citizens is so profitable, why are there countries with lower tax or 0% tax? And it's because they attract people who don't currently live there. These individuals often have money. They're going to come there, they're going to spend money, that's going to boost the local economy. That's going to result in more money in the government's pocket through increased revenue from taxes from their current residents, or it's going to increase the prosperity of its existing residents, meaning the government has to spend less on welfare to look after its residents. It's effectively a government choosing a slightly different business model for itself. Okay, changing global landscape. So in recent years, there's been a significant rise in countries offering digital nomad permits or other incentives for people earning money online to move there. Now, these permits don't usually require individuals to pay taxes in these countries, and it's usually assumed in the permit that they still pay tax in their home country. But the permit gives them the ability to come and live there, rent apartments, buy flat whites and avocado on toast. And why? Because the government gets far more benefit from the non-resident coming to spend money in the local economy versus taxing them. And they were never really going to be able to tax them anyway. So a great example of this was Portugal. It had an exemption for foreign income, which has just ended here in 2020, at the end of 2023. But combined with the 0% tax on crypto, it attracted huge numbers of foreigners to move to Portugal, which made its economy really boom. The side effect of that was that so many foreigners moved there and bought property or rented property, it pushed up property prices. This was great for existing residents who own property, but young Portuguese residents who weren't on the property ladder yet couldn't afford to buy property in Lisbon and had to move further and further out as prices increased so dramatically. Okay, so we jumped around a bit there. We went on a number of different concepts. Let's do a quick recap. What did we learn? There's 3 different types of tax residency: citizenship, residency, and territorial. Okay? There's a difference between a personal tax residency and a company's tax residency, but the company's tax residency can change to the individual's tax residency. Most tax laws were written a long time ago, and the rise of online income has changed the game. As a result, some countries are trying to attract entrepreneurs and other online business owners without taxing them because it's good for their economy, and this is the opportunity for you. We also learned that there's a lot of nuance, okay? So hopefully that was a good overview. In the next videos, I'm going to go into how taxes work with crypto, some countries with 0% tax on crypto, 0% tax on business or low tax on business, how you can go about building an offshore plan, and then I'm going to run through some examples of common combinations so you can see how they all come together.